You just bought your first rental property, and now your tax situation has a whole new layer of complexity to it compared to what you had previously. My name's Matt, and I run TrueBooks, which is a CPA firm that specializes in tax and accounting for real estate investors and business owners. In this video, I want to break down all the considerations that you need to keep in mind when it comes to already buying your first rental property and now what you need to focus on come tax time. And specifically, what you need to keep in mind for that property to get the most tax benefits out of this transaction. Because not only is real estate a great investment vehicle to grow your wealth, it's also got some major tax benefits with it as well. So let's back up. First, why real estate? Well, there's 4 specific areas on what I think are the best key components about real estate: appreciation, depreciation, tax rates, and debt. Now, what specifically about these make real estate so great? Let's take appreciation. Appreciation, you not only have market appreciation, so as you buy these assets, ideally the values of these assets will go up over the long term. Always keep in mind the long term. And 2, principal pay down. As you buy these properties and somebody else is renting them from you, as they pay off the mortgage, that principal balance will decrease, therefore giving you more equity on the back end in these properties. So really 2 forms of appreciation: market appreciation and your tenants paying down the principal, which again gives you more equity in your pocket. Next is depreciation. Depreciation is the Mac Daddy of expenses when it comes to real estate. And the reason is because real estate assets are so expensive, what you're doing with depreciation is you're writing off a piece of the purchase price towards depreciation over the span of owning the asset. But through cost segregation study and bonus depreciation, you can take large depreciation expenses in those early years to help offset some of the other taxable income that you have. We'll get into that later. But depreciation as a whole is a massive benefit of owning real estate when it comes to tax strategy. Next is tax rates. Ordinary income is the brackets that you're familiar with when it comes to how your income is taxed. The 10, 12, 22, 24, and so on. The progressive tax system. As you make more money, you move up in the bracket and you pay more tax. When it comes to real estate, these are capital assets, so they get capital gain treatment. As you guys know, short-term capital gain rates are the same as the ordinary income where those brackets fall. But long-term capital gain rates, 10, 15, 20%, are a lot better than some of those other larger marginal tax rates. So if you're buying real estate and you can get long-term capital gain treatment, your tax rates are typically lower, which helps. So tax rates, we get capital gain treatment when it comes to real estate, unless you're a flipper treating these things as inventory, which is for another video. Last, we have debt. 1, debt is going to be tax-free when you refinance these properties. So owning real estate in a portfolio can sometimes be preferential because at any time that you need cash, you may not have to sell a property. You can just go out and refinance that property, and that is not a taxable event. So if you refinance a property and walk away with $200,000 cash because you just took out an increased loan, that's tax-free cash to you. Yes, you're going to owe that money back because it's debt, but it's not a taxable event to you, therefore causing you to have a large tax bill. And the other piece of debt is, this is how you can really fuel your real estate portfolio, is by utilizing debt to buy more properties. If you had $500,000 cash, you can go out and buy 1 single family home. But if you leverage that money with debt, you can go out and put $100,000 on 5 different homes and walk away with 5 homes instead of 1. So when you start to look at the total return, maybe yes, you're going to carry more debt, but you have 5 properties, which will generate more cash flow versus having that 1 property with all of your money tied into it, and it's going to produce less cash flow because it's only 1. So these are things that you want to start analyzing as you grow your portfolios. So my 4 favorite highlights when it comes to real estate: appreciation, depreciation, capital gains tax rates, and debt, specifically the use of debt. So by now, you've probably already purchased this property, but let's talk about some things that you're going to need to consider through the buy phase of the property. 1, you're going to have to do due diligence, checking out the property, finding a market in which you want to invest in, and something that you see potential in owning, such as buying an asset in an area that's up and coming where you feel you're going to have a strong tenant and not have to have too much heartache while owning this property because of turnover. Some ratios that you want to consider up front when you're running the analysis on these deals, such as cash on cash, return on investment, knowing what you're going to make in return for putting your money into this property. And obviously that's different across all different types of deals. Are you going to buy a brand new single family home that doesn't need much work? Or are you going to buy something something that needs a little bit of work, but now you have higher returns on the back end because you got it at a cheaper price. So all things to consider in the buy phase. Where's the money going to come from to buy this asset? If you have business funds sitting within the business bank account, are you planning to distribute those to your personal self and then buy the property? That's typically what we would see for flow of funds from a business owner. I likely wouldn't recommend buying this rental property directly from your business account. It's nice to distribute the funds to the owner and then use those funds appropriately. So keep in mind of the logistics of moving money around for the actual down payment on the property. Typically, most commonly, we're going to see those come from the individual themselves, not their business, unless that business is buying the real estate themselves. Now, once you have your agent, you ran your ratios, you understand what your returns are going to be, you've identified where the cash is going to come from, it's time to purchase the property. And once you do purchase the property, my last piece of advice here on the buy side is keeping the documents that you get at closing. That huge packet that they send you home with, the best thing you could do, if they don't scan it and give you a copy digitally, is scan a copy, keep it digitally so that you have it ready by the time you start working with an accountant or any sort of estate attorney. All those documents are ready to go and you're not going to waste any time trying to compile them. Some other little nuance items that you'll work on immediately after buying the property are things like insurance and starting to screen tenants. I'm not going to waste a ton of time in this video on that because we're focused on the tax and accounting side of things, but definitely take time to screen your tenants if you're not using a property manager and use that time to find someone that you feel is going to take care of the property. If you ask me as a real estate investor myself, I always place a lot of emphasis on getting someone good in the property so I don't have one of these horror stories like you hear from everybody else on, oh, they ransacked the place and left it a mess and it cost me 10 grand to turn it over to the new tenant. Try to find somebody that you feel is responsible and that's going to take care of the property. And then your insurances, homeowners insurance and things like that, renters insurance, stuff that you're going to have to maintain to keep this property operationally ready and protected. All right, so we've bought the property, we've placed a tenant, and now we need to worry about our finance activities, how we're going to collect rents, what we're going to use to track it, and things like that. So I want to walk you through a list of things to consider once you've bought the property and it's ready to go operationally. First things first, you should designate a bank account that you are going to use specifically for this property. And what you're going to use this bank account for is to collect your rents and pay for any costs on the property. Two main reasons here. There's a legal side of things that we want to keep the books clean and crisp so that in the event that anything comes about after the fact, slip and fall, any sort of legal issues, that you can prove that you kept this property clean and concise when it came to the books and records. You want to be able to locate the activity and say that it wasn't commingled with some other activity, therefore showing that you weren't giving it the true attention as an investment that it should have got. And this really plays a part when you hear people commingling funds and using one LLC to pay for another LLC and things like that. So the best thing you can do is separate bank account to track all of the activity as far as income and expenses directly for that property. And the other reason is the accounting and tax piece. Come tax time, as an accountant myself, if you have a rental property, the first thing I'm going to ask you for is your profit and loss statement for that property for that year specifically. If you commingle your bank accounts and you have two bank accounts where you're collecting rents and you have a credit card over here that you're spending money on for the property, as well as the checking account itself, when it comes to tax time, you're going to have a hard time going through all of these different bank accounts to recompile the activity that occurred for that year on that property. So the best thing you could do, separate bank account, separate credit card, utilize those for the property specifically and try not to commingle any other accounts with those for that property. Now, I mentioned a spreadsheet. At the end of the day for taxes, we are going to need a profit and loss statement as an accountant. I need to see the amount of rents that you made or total. I need to see the amount of cleaning expense, commissions, HOA fees, utilities, and all of your different expenses on a spreadsheet. I will leave a link in the description for the templates that we give our clients. There's a bookkeeping template and then there's a P&L template. So if you already use some other software to keep up with your income and expenses, that's fine. You can just send us that export, send your accountant that export at the end of the year, or you can put it on the template that we give you. Now, I know I've talked a lot about spreadsheets, and that's okay. As an accountant myself, I love spreadsheets and I work in spreadsheets all day. But I will say there's going to be a point in which you want to save more time, and that means using an accounting software like QuickBooks, Stessa, something like that that's going to automate the accounting a little bit for you and save your time. And what I mean by this is the alternative is if you use a spreadsheet, you're going to go into your bank account and have to manually type in the bank activity onto this spreadsheet and account for the different transactions that occurred on your property. If you use something like QuickBooks, you're going to automatically sync that bank account that we just talked about to QuickBooks, and every transaction that comes in or out of that account or credit card is going to automatically sync over to QuickBooks, which then you can go in and categorize. So it saves you a little bit of time and keeps things a little bit more organized, but there's obviously a cost to using something like QuickBooks. Okay, depreciation. This is an example of depreciation and how powerful it is. You can see here that on this property specifically, there was a $90,000 depreciation expense, which brings down the overall net income or net loss to a loss of about 78 grand. But you'll notice that if we back out that depreciation expense, this property is going to cash flow about 12 grand. But on paper, we're going to lose money, which is overall the goal, right? We want to cash flow in real life, but on tax, we want to lose money and not have to pay any tax on the cash flow that we make from these rentals. That is the tax strategy around this. And so again, depreciation is you writing off a piece of that asset over time. Now, more specifically, how do we get a larger amount of depreciation expense? This is by doing a cost segregation study. So let's go over a quick example of depreciation and how this is going to work. Let's say you take a $500,000 single family rental. 30% of that property is land. So that leaves 70% of the 500,000 is the building basis. So let's say that's about 350 grand. A normal accountant that is not specialized in real estate would take that 350,000 and divide that by 27.5, and that would be your deduction per year, which is about $12,700. But if you do a cost segregation study, you're able to get more depreciation in year one. How? Notice in that first example, I took 350,000 divided by 27.5. Well, that assumes that $350,000 single family rental, everything but the land, is all 27.5-year property. But when it comes to depreciation, the IRS gives certain assets certain lives. And the structural components of a building are depreciated over 27.5 years. That is how long they are believed to be in service. If you look at smaller assets within a building, such as look at what you can see here, this chair, some of that, architecture on the walls, the plants, some of the furnishing, carpet, cabinetry, things like that. The interior assets of a building, those can be depreciated over faster periods. So when you look at something that has a 5-year life or a 7-year life, those can be depreciated faster. And what a cost segregation study is going to do is they're going to look at the property and say, hey, you don't just have a building that you bought for $500,000, $350 is the building, $150 is the land. They're saying you have a $500,000 property, $150,000 is the land, and of the $300,000, maybe $250,000 is the structural component, and $100,000 are the smaller assets inside of it. So they're breaking down that building that you just bought, that property that you just bought, into smaller buckets so that we can identify what those are and depreciate them faster. And so in this case, let's say that we've identified of the 350, instead of the 350 over 27.5, they've identified 250 is the 27.5, and 100,000 is bonus eligible year one. Now let's assume when bonus depreciation was 100%, that means that I would get that $100,000 of depreciation in year one, and I still get that $250,000 over 27.5 years, which is about $9,000 there. So you see that I get a much larger deduction if I do a cost segregation study and use bonus depreciation than if I was to just do regular depreciation on a rental property. And that is the power here, is that with this large deduction, it swings what normally would be taxable income to a taxable loss, therefore not having me pay tax on my cash flow from my rentals. Now, when it comes to tax strategy on rental properties, what we just talked about is the first tier in which we want to get to. It is tax-free cash flow. My property makes money, but on paper, I lose money. The next ultimate goal is to try and get that loss that you saw, that roughly $70,000 loss, to offset my other income in my household. So let's say that married couple, one person makes $200,000 at their day job, they're a doctor, and their spouse manages their real estate portfolio. If I can drive a loss from my real estate, there are times that I can use that loss to offset, let's say, that $200,000 that I make and ultimately pay tax on $130,000. That $200,000 minus the 70 would, only pay tax on $130,000. That is the ultimate goal when it comes to real estate. And my biggest tip here is to, one, not only work with an accountant that is dealing with real estate investors day in and day out, but two, keeping accurate records so that by the time you meet an accountant, you're quickly able to identify if you qualify for some of these strategies, and that as long as you have the record keeping, the P&Ls, the purchase documents, any capital expenditures that you spent on the property, you've been keeping track in that bank account that we talked about, you are going to have what you need in order to make this happen quickly and not have to waste so much time catching things up. The last tax piece that I want to talk about when it comes to rental real estate is QBI, qualified business income, and specifically the qualified business income deduction was a deduction that was put in place with Trump during the Tax Cuts and Jobs Act. This may end in 2025, and 2025 may be the last year for it. Currently, they're trying to bring it back, but I want you to know that there still is potential to qualify for it in 2025. And there's things that you need to do in order to qualify for this. And specifically, what QBI is, it's a 20% deduction from your net income on this activity. So let's say at the end of the day, this rental netted you $5,000 for the year. There's a chance to get a QBI deduction of 20% of that, which would be $1,000 just for meeting these rules. And so I want to explain what those are to help get you that deduction. And what better time to know it than early on when you first buy your rental so that you're keeping track of this day in and day out. So come tax time, you're ready to go. Now, these are the requirements that you have to meet to hit the safe harbor. And the first requirement of the safe harbor is separate books and records. So if you reference back to a few minutes ago when we were talking about having a separate account, separate bank account, separate credit card to track all of your income and expenses. Again, this just reiterates how important it is that you do that from the jump. The next one is rental services. At least 250 hours of rental services. This is going to include time to buy the property, managing the tenants, screening your tenants, taking phone calls from your tenants, doing any capital expenditures to the property, managing the property yourself. And the last one is contemporaneous records. You'll see how the IRS loves to make sure that you're doing your job when it comes to documentation and record keeping. So when it comes to contemporaneous records, these are going to include things like hours of all services performed, description of what was the service that was performed, the dates on which service was performed, and as well as who has performed those services. And those are the qualifications that you need to meet to hit the safe harbor for your QBI deduction. Again, something that can really help bring down your tax bill in a time where, hey, you just bought a rental and you need to not only watch every penny, but also try to maximize your tax savings at the end of the day. So all in all, when it comes to buying your first property, have your team organize who the agent is, any estate attorneys that are involved, and especially a CPA. Make sure that you're keeping track of all of the data and the documents that you get through closing. Keep digital copies of them. They're always going to be good to reference back to. Then you need to get your accounting set up. You need to get a bank account and a credit card or some form of accounts that you can separate to only use for those rental properties. And then make sure that you start to explore cost segregation and bonus depreciation with your real estate accountant so that you can determine if it's something that's going to benefit you in your situation to help keep more dollars in your pocket. And always remember, QBI is also something that you can use on your rental property. As always, please subscribe to the channel. If you have anything else that you want me to cover, feel free to drop a comment down below. I'd love to read it and consider that for the next video. And any resources that I mentioned in this video that we have that you can use towards your own rental property, check down in the description. They'll be free, available to you there. And as always, I'll see you on the next one.